Good afternoon. Happy Friday. This is Sean LaBelle of the Decker Hewitt Group. It was a mixed week here in North American markets as we did have U.S. Fed Chair Jerome Powell testify on Wednesday that they will not be moving their overnight interest rate off of zero. Powell remains committed to the zero interest rate policy until we see an uptick in inflation above the average number of 2% and full employment. This point is important to remember because historically, the U.S. Fed has generally acted preemptively to incipient inflation, whereas today they're saying they want to see a hard uptick in the data before they move that interest rate. So this week's Market Watch Weekly just dives into that point, as it's a really important point to hammer home here because we're not going to see interest rates rise, so probably until 2023. This week's Market Watch Weekly just looks at this impressive equity market return that we've seen the last 12 months. Of course, a large part of this return was due to the fiscal stimulus that's been pumped into the system, along with the eventual expectation for economic recovery. It's that latter point that we really focus on, however, as we are getting continued upticks as far as GDP forecasts are concerned. This week's Market Watch Weekly just runs through some of those numbers. And it's that uptick in GDP that's why we remain bullish on the market, because an uptick in GDP means renewed growth in corporate earnings, which of course is a read-through for positive price appreciation in terms of the market's return. So again, we just encourage you guys to take a look at that Market Watch Weekly, and we'll end it there. Hope everyone enjoys the weekend, and we will talk to you again next week. Cheers.